and safely participate in these innovative new financial products. So when myself and Dave Bradley started the consortium about 4 years ago now, blockchain and cryptocurrency were kind of a relatively tiny part of the technology sector. And in the case of tokens and digital assets, these were very highly specialized, segmented types of products that were still kind of foreign to traditional investment community. However, the potential for this widespread adoption of blockchain-based assets were very quickly becoming clear. And during this time, in about 2017 and 2018, initial coin offerings, or like ICOs, they were just like exploding in popularity among the more risk-tolerant investors and create a very novel way of raising funds for companies and projects. ICOs were pretty widely publicized as like the future of finance, and with a pretty incredible amount of momentum. I think about 15 billion was raised in just a single year. Some ICOs were even endorsed by celebrities, media personalities, including sports stars, high-profile technology leaders, and they were used by companies to kind of generate capital for exploratory technologies or acquiring assets, funding new projects. But it was very convenient for many companies because with all the hype behind them, it was very much so hiding the fact that these investments were completely unregulated. And as we watched what soon came to be called the ICO bubble play out at the consortium, we were very, very concerned about the lack of protection that these products gave investors and the looming possibility that many of them would turn into vapor with absolutely no possible recourse. And in 2018, when that bubble inevitably burst, it's pretty much exactly what happened. Major ICO raises turned out to be completely fraudulent, no actual value behind their issuance. And so like, what went wrong? According to Protocol Lab CEO Juan Bennett, the market forgot a very, very important principle, and that's just because you call something a blockchain or an ICO, it doesn't mean you aren't subject to normal laws. And ignoring this fact lost investors billions, led to hundreds of persecutions for security law violations, and gave pretty much the entire blockchain and cryptocurrency sector a fairly poor reputation. And it's taken years to recover from that, and we're still recovering. While I am definitely convinced that our industry is truly creating the next generation of finance, I do believe it needs to be done right. And I realize that in our role as Canada's national blockchain ecosystem organization, the consortium has the opportunity to play an essential role in helping shape these strong regulatory oversight that's going to help protect investors while building a very vibrant digital economy. But this requires a very highly collaborative process, and that unites the financial services industry with the technology community, legal experts, as well as regulatory authorities in a powerful brain trust that's going to help to create a safe and more compliant guide rails for digital assets that we need to move our industry forward and definitely not replicate the mistakes of the past. So now we're hosting regular industry roundtables that bring together the expertise from our consortium's legal, finance, and industry committees. And that supports the dialogue, idea generation, and lay the groundwork for this multidisciplinary collaboration on these very critical issues. Our consortium is really proud to be helping shape standards that will make digital assets comparable in safety to conventional securities. So in today's roundtable, we'll be exploring the very diverse issues, including stablecoins, the role of custodians, the need for strong ecosystems, and very importantly, what achieving regulatory certainty could mean for Canada's growth. And as the world moves towards a new digital economy and investor capital continues to seek out innovative types of assets, there are incredible benefits for Canada in leading the charge on legitimizing digital assets and integrating them into our financial system. And we're just at the starting gates of a global financial revolution that will absolutely transform how we understand value, conduct transactions, as well as acquire capital. And digitization has the power to make investments lower cost and more accessible to a wider range of participants. The kind of collaboration happening in our virtual think tank today is absolutely going to help us maximize these economic benefits while minimizing the risk to both a catastrophic collapse like the ICO bubble of 2018 and the countervailing risk of lagging behind the rest of the world in this accelerating digital transition. So our consortium, definitely we couldn't achieve these goals without the support of our incredible sponsors and members. We are a completely volunteer organization. and we rely on our industry and technology partners to help us in our work to move Canada's blockchain and cryptocurrency sector into a prosperous and safe new era, one that could have an increasingly large impact on our overall economy. So I would also really like to take this moment to thank Denise Weirs with the Alberta Securities Commission, her incredible support and effort in helping us put together this roundtable and our questions and bringing so many of our honored guests here today. So big thank you, Denise. So by the attendees from organizations such as IROC, the Securities Commission from across Canada, FinTech, OSIP, et cetera, they're in attendance today, but they're here to listen to the dialogue. They will not be providing comments. If they do choose, though, they may ask questions to the group during our Q&A period. So I just wanted to let everyone know that. I would also like to note that this meeting is being recorded and will be available to the public on our YouTube channels as well as our website. So thank you so much for participating today. And I really encourage anyone, if you'd like to learn more about our organization and the projects that we're involved in, please visit us at canadablockchain.ca. And I'm looking forward to a really great discussion. So I'm now going to hand it over to Dina Manville from CipherTrace.
Thank you, Kalea. And thank you again. Just want to reiterate how grateful we are to have everybody who's dialed in today. This is an extremely important topic, and we've brought together some really, really incredible people who are just really knowledgeable about different areas that are important to explore when we're considering what this ecosystem looks like in Canada. So what I'm going to do is, this is not going to be a slide heavy presentation by any means, but I wanted to set a little bit of regulatory context for everybody, so we're all working from the same point of reference. So what I'm going to do is just a really quick screen share here with you, and we can certainly make these available for you all after the presentation today. So we're going to talk a little bit about the driving forces here. And Clay, can you just give me a heads up that you can see this? Just a confirmation for me.
Yes, I can see it. It's full screen.
Great, lovely, thank you. Okay, so I want to start this conversation back in 2018. So this actually starts with, I mean, everyone knows that the Bitcoin white paper was written and it was sort of released right after the financial crisis sort of kind of started melting down, and we didn't really see a whole lot from a regulatory standpoint up until one really significant event that happened shortly after this communique was published. So in 2018, when the G20 got together, the topic of cryptocurrency was discussed, and they decided that cryptocurrencies offered technological innovation that could possibly improve the efficiency and inclusiveness of the financial system and the economy more broadly. Mark Carney, who was at the time the chief at the Financial Stability Board, as well as the governor at the Bank of England, commented that cryptocurrencies did not pose risks to global financial stability at that time. Now, less than a year later, we had this massive project, this white paper that was released by Facebook, where they were proposing, and this is version 2, by the way, that I have up on the screen. This can be downloaded right from the internet if anyone cares to give it a read. The mission here was to, as you can see, enable a simple global payment system and financial infrastructure to empower billions of people. So this is basically a stable coin. It's pegged to other assets. We're going to talk a little bit about stable coins today. And when the G20 looked at this project, they realized that a software company with an installed user base the size of a country was preparing to launch a global digital currency that would not be handled by a nation state. This is the first time something like this had happened. And so 1 month later, when the G20 got together in the communique document, they had very seriously changed their interpretation of cryptocurrencies and the potential implication of these assets on the global financial system. They determined now that cryptocurrencies did in fact pose serious public policy risk, serious regulatory risk, And they asked that the Financial Action Task Force, which is the global anti-money laundering watchdog, as well as the Financial Stability Board, as well as the IMF, undergo considerable research with respect to cryptocurrencies to better understand issues related to monetary policy and monetary sovereignty, right? These massive economies looked at this new technology and realized that it had very serious or potential serious ramifications on the ability of nation states to conduct monetary policy. So this project is what has precipitated a lot of the regulatory changes that everyone on this call is likely familiar with. So what happened next was the Financial Action Task Force published their new set of recommendations, and they made modifications to recommendation 16, which is known as the travel rule. Now, the modification basically brought cryptocurrency businesses who were facilitating the transfer of digital assets, who were safekeeping digital assets, it brought them under this sphere of influence, and it mandated, or these are non-binding, by the way, legal obligations. So member countries will take the recommendations, they will transpose them into local law, and that's where you have your legally binding matters. Now, what was significant here was the travel rule was modified to bring cryptocurrency businesses under this purview. And this was, it looked like the application of the Bank Secrecy Act right onto cryptocurrency businesses. So the rules changed such that businesses were would be now required to collect, to store, to transfer, and disclose when legal process warranted the disclosure of information related to beneficiaries and originators in virtual asset transfers. Now, this is important because at a protocol level, the technologies that we're talking about don't inherently capture the data that FATF was looking for. And so this was an extraordinary effort by industry and regulators and nation states to come together to figure out how to solve this very complex technological problem. What was required was building this new out-of-band mechanism that allowed for information to flow between organizations who would fall under this modified recommendation. Now, a year later, the Financial Action Task Force published their 12-month review. So they had looked at everything that industry had done over the last 12 months. They had examined feedback that they were getting from member jurisdictions. And there was one particularly unsettling part of the new report. It was section 4, subsection 54, specifically, that stated that if a nation state believed that the risk associated, the money laundering risk associated with self-hosted wallets. So this is where I own my assets on a little device, or my assets are being custodied by me rather than by some third party. If a nation state viewed that money laundering risk as being too high, they might consider completely banning those types of transactions. So now nation states looked at this new component and said, okay, how do we approach this? We have this technology that has this great promise of financial inclusion. We don't typically regulate people, we regulate businesses, and now we have this technological complexity that we're not quite sure how to grapple with. FATF did a second 12-month review. So now the expectation at this point in time is that member countries have taken the recommendations, they've worked on them, they've figured out how to bring them into local law. But what was actually found was that less than half of the reporting jurisdictions claimed that they had passed the necessary rules, regulations, the necessary laws that FATF was initially looking for to mitigate risk associated with criminal activity, money laundering activity, terrorist financing activity happening on blockchains. And what we found is that most jurisdictions that fall under FATF are non-compliant with this new travel rule modification that they made for cryptocurrency businesses. So from a regulatory standpoint, not only are cryptocurrency businesses having trouble figuring out how to build these new technologies that sit on top of blockchains, but nation states are also dealing with complexities around how to actually implement these new rules, how to understand this new technology, how to build ancillary pieces that enable all of these things to kind of work together and fit seamlessly. So there are a couple of other things. I'm going to stop my screen share here. There are a couple of other things that that we consider as well that regulators globally are dealing with, governments are dealing with, virtual asset service providers are dealing with. From a regulatory standpoint, we have other considerations that we need to be thinking about, such as DeFi. So DeFi is a topic that is massive just on its own. It is largely out of scope for today's discussion. We do intend to host another roundtable where we can explicitly cover DeFi. But these are situations in which we have projects that now maybe don't have management structures and governance structures like normal businesses. We take these functions and we distribute them to lots of different parties. How do you regulate something like that when you can't, or you don't know who to hold accountable for decision making? Other components that from a regulatory standpoint are kind of trending in terms of how we're trying to wrap our heads around these things are still the self-custodied aspect. Again, we're not usually in the business of regulating people, we generally regulate businesses. So how do we allow for, moving forward in the vein of, we're trying to eradicate money laundering, we're trying to uphold existing regimes, but we also want this technology to bring all of the promise of inclusion. How do we kind of balance these two different objectives? The other thing that we're being forced to think very critically about is data privacy, right? So all of this work that we've done over the last few years in terms of GDPR and PIPEDA and CCPA in the United States, these are data privacy regulations that are very much needed in the digital age, right? These are mechanisms that we give to people to enable them to protect their data, protect their digital self. And originally, these regulations weren't developed for databases that never forget, right? Part of the beauty of GDPR is that you can say as an EU citizen, I have a right to be forgotten. And that is a right that every business that services you, regardless of where that business is domiciled, has to respect that right. So how do we modify these rules and regulations such that they work with these new technologies that we're building? So there's loads to think about here. There's a ton that we can do. I think when we're looking at Canada as a jurisdiction, we have an opportunity to learn from maybe some of the early adopters in this space. I've worked very closely with Bermuda as a jurisdiction for a number of years, even outside of crypto. And while no one's getting it perfect, I can say that they were very early to establish a regulatory framework, which is very comforting to people who are building projects in this space, because it gives them the space, the clarity that they need to develop safely, to understand what they're doing and what the potential ramifications of those decisions are and will be. I think we would be better served as a country if we had better lines of communication between government, regulators, industry, policymakers. Events like this allow people that are deep inside the technology to come together with policymakers and government and regulators whose goal and objective are kind of wrapped around this consumer protection model. How do we keep people safe but allow innovation to happen? When we create forums like this where we can bring all of these distinct groups together, we really propel ourselves in a direction that allows us to innovate safely. Because the way that I sort of see this technology unfolding, I mean, Kalea alluded to this. This is not solely a financial technology. This underlying technology will be applied to healthcare. It will be applied to government. It will be applied to supply chains. And the way that we treat this first use case is instrumental in giving us direction for how we treat additional use cases. So there's a lot to think about. I'm really excited that we're doing this roundtable, and I hope that everyone that's dialed in and that's listening takes away a lot from this. We're working with this fantastic new technology. I have no doubt about the incredible things that it's going to do for humanity. And I really want to see Canada engaging with one another so that we don't lose the already small talent pool that we have. We don't want to drive people that want to build in the space to other places. We don't want projects that are currently living here re-domiciling to other places that might have more regulatory clarity and better lines of communication between government, industry, policymakers, regulators. So I think doing these kinds of events really set us up for working together, collaborating, and understanding all of the opportunities that lay ahead. So with that, those are my closing remarks on the regulatory front. And Eric, I will pass it over to you.
Awesome. Thanks, Dina. I appreciate it. I think I echo a lot of what Dina said. And we're going to jump into introducing the panelists that we have who are experts in their domain, as well as starting to dive into some of the specific topics that we think pose a risk to innovation in Canada, as well as to consumers. We're also going to look at suggestions and feedback and from some of these industry experts on what they're seeing in the industry as best practices, and even what's happening in other jurisdictions to hopefully inform improved policy and decision-making here in Canada to support this industry. So I'll start off with myself. I'm the co-founder and CEO of Bidali. I'll be moderating the panel. At Bidali, we provide financial infrastructure that uses blockchain technology to provide better, cheaper, and more transparent financial services, specifically within the payments space and stored value. We're a Canadian money services business registered here. We were one of the first ones that were using cryptocurrency and registered as well. We're now operating in the process of setting up operations in Bermuda, given their regulatory clarity, and working with the government, with support of the government on digital currency and digital payment initiatives. I myself hold a bachelor's degree in computer science from the University of Calgary, and I've been building software and distributed systems for over 15 years. I previously spoke during the World Economic Forum in 2020 on the future of money, and during the COVID pandemic was asked to present to the Standing Committee on Industry, Science and Technology in the House of Commons on Canada's response to the COVID-19 pandemic. I'd like to introduce Dina, who you just heard from. She's the sales director at CipherTrace, a leading provider in cryptocurrency and anti-money laundering and forensic technologies around the world. She's also the director of industry engagement for TRISA, T-R-I-S-A, an open source solution to the Financial Action Task Force travel rule. And she is a specialist in international blockchain regulation and advisor to various global regulatory bodies, as you've already heard. Next up, I'd like to introduce Brian Mosoff. He's the CEO of Ether Capital, based in Canada, a publicly traded crypto asset and investment corporation. He's a member of the Cryptocurrency Working Group of IROC, a member of the FinTech and Blockchain Stream at the Creative Destruction Lab, one of Canada's top tier accelerators, and has served as an advisor to the Ontario Securities Commission. He's an expert on Web3 technologies, decentralization, and peer-to-peer models, and has been an active member of the cryptocurrency community for nearly a decade. We also have Pamela Draper, who is the president and CEO of both Patino Payments and Bitvo, and is the director of the Canadian Blockchain Association for Women. Before leaving her role as director of equity capital markets at Bank of Montreal to become the CEO of Bitvo, one of Canada's leading crypto asset exchanges, Ms. Draper spent almost 15 years in investment and corporate banking at top-tier Canadian banks. We also have Nathaniel Day, or Nate. He's a lawyer at Miller Thomson and advises clients on a wide variety of matters, including securities, enforcement, and regulation. Nate previously worked in the securities division of the Financial and Consumer Affairs Authority of Saskatchewan and was a member of the CSA Regulatory Sandbox and the CSA Derivatives Committee. While at the FCAA, Nate collaborated with other regulators to develop policies relating to cryptocurrency exchanges, and notably, he represented Saskatchewan with respect to the approval and regulation of Wealthsimple Crypto, the first regulated cryptocurrency exchange in Canada. We also have George Bordianu. He is the co-founder and CEO of Balance, one of Canada's leading digital asset custodians. George is a second-time founder with a strong technical background, as he holds an MSc, Masters of Computer Science, from McGill University. Before Balance, worked in the digital media sector at 500px's Director of Engineering, which was acquired a few years ago. Prior to 500px, he was the co-founder and CTO of Your Extra Life, a social mobile startup whose app was featured for many months on the front page of the App Store in the US, Canada, and 75 other countries. And then last but not least, we have Evan Thomas, who is the head of legal for Wealthsimple Crypto, Canada's first crypto asset trading platform to be registered as the restricted dealer under the Canadian securities laws. So prior to joining Wealthsimple, he was a litigator at Osler, Hoskin, and Harcourt, focusing on cases involving technology and data. And as a litigator, he represented various individuals, platforms, and projects in connection with disputes or regulatory matters involving crypto assets, including the 3iQ Corp and its hearing to obtain approval for the first Bitcoin fund, a major creditor of Quadriga CX in the Quadriga, and a major creditor of the Quadriga CX and the Quadriga CX exchange bankruptcy proceedings. So I think you can see, we've assembled an amazing panel. What I would say wholeheartedly is some of the most knowledgeable people in the industry. Of course, there are many others across Canada that are very knowledgeable. That's one of the things that we're very fortunate to have in Canada. We have an immense amount of talent here. I think one of the risks that we're seeing with some of the lack of regulatory clarity is that some of this brain drain is moving to other jurisdictions. And as a result, some of the capital is also following it. We're going to start to dive into a few different topics, ones that we think are most pressing. As Dina mentioned, DeFi or decentralized finance is a very hot topic. It's something that we want to address, but it's very deep. And so we didn't feel that we could address it appropriately alongside some of the other topics. And really it deserves its own roundtable on its own. So we are looking to do something likely in the fall. I'll let Kalea speak to that. It's tentative at the moment, but if there's interest, we definitely would like to address that. Now, in this panel, what we'll be looking at is crypto asset custody, stablecoins or fiat-pegged crypto assets, and the opportunities and challenges that they present, investor risk and information. So how do we protect investors? And then the tax treatment of crypto assets themselves. Because that is also posing some challenges. And a lot of these topics are actually quite interrelated, which is why we wanted to group them together. So I'll start off with crypto asset custody and then start to open it up to the panel. I think crypto asset custody is a very nuanced topic because blockchain technology and modern cryptography have challenged the nature of our traditional definition of what custody is. Today, there's a spectrum of custody options ranging from self-custody to partial custody via multi-signature methods to comprehensive custody with specialized entities with insurance and SOC 2 designation. However, over the last year, the absence of enough regulatory clarity and a clear path to become regulated has hampered Canadian custodians. The market need has outpaced our ability to provide this regulatory clarity, and as a result, there are currently billions of dollars in securities and cash held for Canadians by foreign custodians. At present, this presents some additional challenges and risks, particularly with regard to taxation, cross-border asset rights, proof of ownership, and even potentially geopolitical risk. I'd like to explore some of these nuances as well as industry best practices and the challenges with our current regulatory framework with our highly regarded panelists. So I'll open it up first. I would say, what are some of the industry best practices for custodians today? Maybe pointing this to George, who is and is running a crypto asset custody platform, specifically with regards to securing crypto assets in custody, enabling redemptions, transparency, and appropriate cybersecurity procedures. You know, who is doing this best in the world, and what are some of the best practices?
Thank you so much, Eric. Thank you, Dina, Korea, everyone who dialed in. Just to round up the bio a bit, I guess I'm George from Balance. You can find us on balance.ca. We present ourselves as Canada's leading digital asset custodian, and I was about to be Canada's most poorly dressed panelist. I had to do a quick change act at the beginning of this because I had it half an hour later in my calendar. So if you didn't notice it, that was the point. Now, to dive a bit into the question, we have been in the business for 4 years as a digital commodities custodian and slowly building up the post-trade financial services stack. Most recently, we've been working on a settlement system with delivery by ledger entry, and hopefully with a bit of luck, if we do find a financial services body that wants to take oversight over some of our businesses, maybe we get to use the same technology towards digital securities and eventually build it all the way up to a centralized clearinghouse for digital securities. That's the long-term vision. Now, over the last 4 years since we've been building this, we've learned a few things about digital asset custody. And once you get down to the nitty-gritty, there's only so many architectural models that you can arrive at. So as far as best practices and some of the best practices that are being abandoned more recently, which I'd want to encourage everyone that is using a third-party custodian to not necessarily do. The use of offline storage for the vast majority of the assets is a key component for any custodian. More recently, there has been a rise in the market of various vendors that advertise very interesting cryptography technology under the general umbrella of multi-part computation schemes. Now, nonetheless, although the security profile of those solutions is higher than what a typical hot wallet or warm wallet used to be considered in the industry up until recently, at the end of the day, they are still building systems that can electronically be accessed on demand to cryptographically sign something. There's only so much degree of security that you can guarantee on such an architecture. This end of the day, if either the vendor or the client that uses the vendor gets compromised end to end, either of the parties, you can have unauthorized access. Now that can get stronger, and that or can become an end if instead of an electronic assistant that can be electronic access on demand is used to store the bulk of the assets, you introduce a physical control and a physical separation, an air gap separation in place, and you insist on for example, someone having to go to a bank-grade vault that's under access control monitoring and 24/7 guards at the door, for all intents and purposes, in order to complete a signature on a transaction, be able to broadcast it to a blockchain system. So again, as far as the security profile goes, nothing beats offline custody, nor do I expect that from an architectural point of view, any cryptographic scheme where the system can be electronically accessed can beat the security of a full offline storage solution. So that's one key point. Two more things that I'm gonna mention briefly. So one is the use of omnibus wallets. We have been actively trying to discourage this to some extent as we've been building our own business. Now, the goal is not to shoehorn any client into a use case that doesn't fit what they want to do. There's a variety of reasons as to why omnibus accounts existed historically and why they're still being used today. But some of the reasons why omnibus wallets were being used was because it's easy. It's easy to put everything in one place and then deal with the separation and who has what at the chart of accounts level within the organization. We are in 2021, we are at a point where technology does enable solutions such as ours to easily allow clients to create tens of thousands of hundreds of thousands of fully segregated wallets if this is what it takes, and have the same kind of separation of assets that typically the omnibus model you'd have at a chart of accounts level, to have it directly at the wallet and storage level. Not only does this make this improve the security profile for the client, as there's no particular honeypot of assets that can be compromised in any one event, but it also improves the auditability and the transparency from the end user side of things, because end of the day, if you fully segregate the assets for each client, and again, the platform from the assets of their own clients, each party gets to individually and independently audit them using a third-party blockchain explorer. The last key piece, I guess, that I would want to bring as far as industry best practices, direct access to assets at the custodian level. Again, some of the post-trade financial services stack that we have, the way that in its current incarnation and the way that that looks today, some of the reasons for which it looks in certain ways are mostly historical and legacy reasons. For example, if I buy Apple shares through a brokerage of sorts, to the best extent of my knowledge, I can't necessarily show up at the Canadian Depository for Securities and say, can you please give me my certificate of stock on demand whenever I want to do. Just isn't feasible, from an operational perspective, from who's going to do that support. Now, the interesting piece about these crypto assets is intentional or non-intentional, some of them can be used as better instruments. And, while we've been building our own solution, we've been trying from the ground up to effectively give direct access to the assets for any user, even if that user does eventually arrive through some form of trading or exchange platform, or hopefully down the line, a regulated broker dealer. It is the equivalent of trying to give every retail investor an account at the DTCC or CDS. Is it feasible in practice? I don't know. Let's find out. We have some new interesting technology that's definitely worth exploring. So these are the key pieces as far as best practices from a custodian. If there's anything to be taken away home, is offline storage does remain the gold standard for the foreseeable future.
And I wanted, thanks, George. That was very insightful. I think I'd actually like to get yours and Pam's opinion on how to effectively manage, or what are some of the best practices around effectively managing hot wallet structure? Because cold storage being one thing, but if you're trading or if you need to process withdrawals, how do you ensure against some of the risks of, or what are some of the best practices around ensuring that the private keys used for withdrawing from a platform aren't accessible to a rogue employee or something like that? Because I think now that we've seen a lot of platforms start to mature, some of the more sophisticated cybersecurity attacks, I think, are seen in crypto before they're seen in a lot of other industries. And one of the more prominent ones is phishing attacks, and some of them have been quite sophisticated. So maybe if you can comment, Pam, and then we'll come back to George on some of the industry best practices you've kind of seen in managing hot wallets.
Yeah, absolutely. I think first and foremost, and we all know this, but it's worth repeating, is any crypto assets held in hot wallet storage should be considered at risk. So the best way to mitigate that risk is to absolutely minimize the amount that you have in hot at any one given time to only the amount required to manage your business. So only the amount to require very near-term withdrawals from your client base, and be constantly actively looking at that number, making sure that it's de minimis to your business. So if it was all taken tomorrow, hackers become increasingly sophisticated all the time, your business would survive. There's no insurance currently on the hot except for self-insurance. It's cold, it's insurable, and a big reason of that is the risk in hot. So minimize the balance, of course, to something that is de minimis to the business. But then also there's technology behind hot that can assist in further mitigating it. So making sure that it's robust against attempted hacker attempts at that hot, and then also adding, to your point, Eric, on rogue employees, adding in to that technology various levels of permissions to say, no one transaction can exceed this without multiple layers of permission, and no multiple transactions in any one given hour can exceed this. and then no multiple transactions in any one given day can exceed this. I think that is good practice to ensure that no one can act unilaterally without triggering certain metrics. It will require collusion on multiple levels, and spreading that out over time periods where the monitoring systems would be able to catch if someone was doing that.
Yes, thank you. So I think part of it, what I was kind of getting at there too is, I think what we've seen with the technology, and George can kind of confirm, is there's a lot of power in the multi-signature constructs and the programmability of all of these things. But there is a component that also relies on a business's internal cybersecurity processes and procedures. It's not, at least we're not at a state yet where you can just assume that everything is going to be programmatic and just be totally secure. There's going to be other vectors that need to be kind of taken care of, similar to traditional financial institutions.
Maybe if I may just riff on this for 1 second more. If we're to look at a taxonomy of security profiles for wallets, I would split it into offline wallets, warm and hot. The distinction I make between warm and hot is a warm wallet is a wallet that can be electronically accessed, but not on demand, or definitely not automatically. So say maybe I run some sort of statistical arbitrage model that involves me sending large amounts of assets to some exchange, for my own investing purposes, and I need to send those every 6 hours. And the typical access time for offline wallets is up to 2 business days in case of most custodians, ourselves included. Then an offline wallet won't do. But I can most definitely have a warm wallet that remains offline for the majority of the day, and I connect it once every 6 hours when I actually need to perform that particular transfer and take it back offline. For the hot wallets, end of the day, if there's a need for a deep programmatic integration where someone presses a button, and yes, there might be a few automatic signatures being put down the chain, but there's no further manual input, either from the client side or from the custodian side, you definitely need to minimize the amount that's being held there for the at most that you need within the liquidity window period that you need it in. And I guess to close off with one interesting tidbit that Pam brought into the conversation, as far as insurance, and particularly crypto crime coverage, because this is the type of insurance that we would want to have on these warm and hot wallets, the available coverage limits capacity are extremely limited. The highest policies that we've seen out there are 25 million to maybe up to 50 million. Fireblocks as a vendor advertises a 25 million worth of coverage on what's effectively 400 billion worth of client assets that are being secured from all of their clients. 25 million on 400 billion isn't going to do much if there's any sort of event. So again, minimizing the amount held and taking the insurance policies, limits, deductibles into account as well, because past a certain point, as far as hot and warm wallets go, the architecture, the security of the system doesn't get stronger than that. You have to mitigate with insurance.
Yeah, so I think that's something that coming back from Bermuda, which is a huge insurance sector. I think that's something that, even talking with Alex Daskalov, who I know is in the audience as well, who's another crypto custodian here in Canada, focused heavily on insurance. I think that the challenge that we're still seeing in the insurance sector is that they're still trying to wrap their head around how they even insure this, even if the risks are significantly lower than even in other industries in terms of a loss, if procedures are done right. I wanted to go back to Pam just briefly before we move on to another question. In terms of best practices, are you seeing more of a trend towards warm wallets as opposed to hot? And I guess the question as well, I will almost make a comment, is that I think there is a lot that, in my opinion, financial institutions could be learning from the crypto asset industry, because I think the technology that's deployed now, not only was it able to be built from the ground up, but because of the cryptographic security and some of these policies and procedures and the higher risk of getting phishing or ransomware attacks or other types of attacks, a lot of crypto asset businesses, especially exchanges, have had to become very mature very, very quickly. And in my opinion, would be leading in terms of their cybersecurity policies.
Yeah, for sure. I don't know if it's a trend towards warm or the industry growing up as a whole. And kind of what I mean by that is at first when the industry started, maybe they weren't aware of the risk of hackers and bad actors, but certainly we saw some examples early on. And I think that the players that for the most part remain now, ourselves included at BIFO, have always been very cognizant of that and actively managing the risk between hot, warm, and cold. The reality of an exchange is it has to be real time. So there has to be some element of hot, but also helping have a little bit of warm on hand before you go into cold. And as George says, you imply those delays helps manage the functionality of it. And so I think exchanges that are present today actively use it a lot more, but I think that's a function of the more legitimate players remaining in the space and servicing Canadians.
Yeah, I would agree. I want to turn the next question to Evan, Evan Thomas. You know, at Wealthsimple Crypto, you're now one of the first regulated. I think a lot of the assets are not currently being custodied with Canadians. One of the questions I have for you, I guess, would be, should Canadian policymakers be concerned that crypto funds or platforms requiring qualified custodians have until recently had to use foreign custodians? And what risks does that present to Canadians and to platforms in Canada?
Thanks, Eric. Appreciate the question. I'll just preface it to anything I say in response to that or any other questions should be considered my own personal views and not the views of Wealthsimple, and that I presume applies to the others on the panel who are here. But to your question, I think the short answer, in my view, is no. I don't think it's a matter of concern. We are not concerned in the traditional finance world about the billions, maybe hundreds of billions of dollars worth of US securities that are held for Canadians with foreign custodians. This happens in other contexts, and we've accepted those risks. But in crypto specifically, if it were not for foreign custodians, we would not have what we have today. In 2019, there was precisely one institution in the world that met the definition of qualified custodian for the purpose of investment funds, and that was Gemini. I think that's changed, might be 3, maybe it's more, whatever it is, the number is something you can count on, one, maybe 2 hands. And Canada would not have all of these, very successful funds that hold Bitcoin and Ether were it not for the existence of custodians, foreign custodians that meet the definition of qualified custodian under the applicable national instruments. But beyond that as well, the pool of custodians generally remains very, very, very small. We have, I think it is as of this month, precisely one institution in Canada that would meet the definition of qualified custodian. As I say, a very small number that are foreign. And for those that have to hold crypto assets in custody, that's not very many to choose from. And this is particularly important. It's important that there be options, and particularly important taking into account something that George said about insurance, which is there is a lack of insurance in the industry that's available to whether it's platforms or funds that hold crypto assets. There just isn't coverage available. So in that environment, one of the ways of mitigating risk is to diversify where assets are custodied and hold them in multiple custodians and reduce the concentration risk, and also take advantage of the fact that each platform is going to have its own limit. So if the assets are spread between multiple custodians, then potentially you have access to greater insurance coverage. So for all those reasons, I don't think there is a reason to be concerned. Certainly the foreign custodians have shown that they have the technical capabilities, the controls to protect crypto assets. It was foreign custodians, after all, that were the first to get things like SOC 2 Type 2 reports that demonstrated the adequacy of their controls. So I don't think there's a reason to be concerned from a policy perspective about the use of foreign custodians. In fact, I think something should be welcome, because ultimately it's going to widen the options available to Canadian players and help them mitigate their risks and protect investors.
Okay, thanks, Evan. I'd like Nate, maybe if you have any opinions on this. I know speaking with Wayne Logan previously at Miller Thompson as well, he said one of the challenges with foreign custodians can sometimes be the chain of custody and what would happen in that event. Would you echo kind of Evan's perspective, or do you think that it's maybe a little more nuanced than that?
I think overall I would echo Evan's perspective. I don't think there's a huge concern with using foreign custodians in general. Gemini is a great example of a foreign custodian, which is kind of top of the line when it comes to custodianship services. I'd agree with him there. I think from just my background as a working for one of the regulators, I think where some of the concern is, and this also kind of plays into my role now as legal counsel in the private sector, is that this could be an indicator of uncertainty and some resulting hesitancy from would-be Canadian crypto asset custodians, where essentially companies who are looking at getting into this space aren't entirely certain about what are the regulatory requirements that I need to meet to make sure that I'm on the proper side of securities laws. I've run into this issue myself. I know that there is some guidance from the CSA, particularly I'm talking about the joint IROC CSA staff notice 21-329, which I believe came out March 29th of this year. So I know the regulators have been working on providing some certainty to members, to marketplace participants, particularly would-be custodians, but I do worry if the lack of Canadian custodians is a reflection of a need for more regulatory certainty in this field.
And maybe more standardization. I mean, I don't really have a dog in this fight in that we're not an exchange. But I think what I've kind of seen from the outside is that it's still talking with other people, other businesses within the crypto asset industry. It's still not entirely clear what the process and procedures are for becoming a qualified custodian. I think this is changing very rapidly, but I think the risk, in my opinion, that we're seeing is that the market demand and the pace of innovation is outpacing our ability to provide regulatory clarity. And as a result, I mean, even ourselves, the reason why we're doing one of the reasons why we're starting to do work in Bermuda is because they have a framework that does provide some of that regulatory clarity.
Yeah, absolutely. That would be something that'd be extremely helpful. I think some sort of standardization that we could all point to and say, you need to do this, this, and this, and this. Absolutely.
I am going to diverge a bit because I do have a dog in the fight, if it kind of makes sense. Look, should we worry about the hundreds of millions or billions of securities that are being held cross country from the US and Canada and vice versa? Not really. Like yes, there are discrepancies in the regulatory regimes. We've litigated this over decades at this point. So whenever there's an edge case or something goes wrong, we know what to do with it. Should we worry about the billions of crypto assets that are currently being held over in the United States? Maybe. Like, it's all good until someone loses an eye, if it kind of makes sense. So if there is an event at Gemini or any other of those foreign custodians, it's not entirely sure how that would be litigated. And if we're to discuss that, I would much rather litigate issues relating specifically to retail assets on Canadian grounds and territory under this jurisdiction rather than the US jurisdiction. The other side of this flip coin is or coin rather than a flip coin. So on the other side of this coin, you also have the fact that yes, the number of foreign custodians that are meeting qualified status in Canada is increasing, but now we're in a situation where, again, because of discrepancies in the regulatory regime, I might be pushed, say, if I were a trading platform, like in order to satisfy all the security law requirements in Canada, I might have to use a custodian that meets qualified status. I might say, look, I want to do BitGo instead of Gemini, right? They might or might not meet qualified status. Now, if you take a look at Fintrax's MSB registering database, they haven't registered themselves as a money transmitter in Canada yet. So that's in order to satisfy the securities administrators, I might have to break Fintrax regulation, right? Not a nice place to necessarily end up in. Now, who knows why BitGo hasn't registered yet, and they're operating as an unlicensed money transmitter. In the United States, there's an argument to be made that based on FinCEN's May 9th, 2019 guidance, they're only doing money transmission insofar as providing the custodial services that they do, and that's not their main business activity. Therefore, they should be exempted from registration. There's a legal argument to be made in the United States. Does the same argument apply in Canada under Fintrax's guidelines? Not really. As far as I can read the registration triggers on Fintrax's website to do virtual currency transfer services to anyone, you should register as an MSB dealing in virtual currencies. So again, discrepancies in the regulatory regimes, when we arrive at the edge, they do cause issues, and I would much rather litigate this in Canada than in the United States or anywhere else.
Yeah, George, I'd like to add on top of that. I agree with all of the commentary here. I think the complexity, and this is something that is particularly obvious in the vantage point that I'm at, given that I work very closely with law enforcement agencies, especially in Canada. The complexity with having assets that are custodied in a foreign jurisdiction it's something that we don't often think about, but when you have matters of, fraud, asset recovery, if a law enforcement agency in Canada needs to write a production order to a US, let's say, entity, we have a mutual legal assistance treaty, an MLET program, which is basically like a coordinated partnership between these two jurisdictions, but it's not seamless. It is extremely difficult. There's a lot of red tape. It's very, very lengthy. So some of the complexities when we're talking about the law enforcement angle of custodying your assets with a foreign organization are kind of tangled up in what kind of information you can ask for and how quickly you can get that information from that foreign organization.
If we're talking about cybercrime, speed is always of the essence.
Yeah. I'll maybe just add one point. I come at it from a little bit of a different angle. And my point is that I've made before with the regulators in the industry is more about the Canadian ecosystem. I think that we would be short-sighted to say that Canada can't come up with viable solutions that compete on a global scale. And coming from a traditional banking background, could you just say that JP Morgan and Goldman Sachs provide the Canadian market with the best investment banking services around? I mean, you could potentially argue that, but having worked at Canadian banks, I would say that the Canadian banks have a more vested interest and serve the Canadian market better because Canada on a global scale is relatively small. So if you leave the service providers of the Canadian market to large global companies, they're not going to care as much about our consumers and our businesses potentially as homegrown viable solutions right here.
Yeah, and I think these are all very fair and well thought points. I think one of the things that I'm seeing as well is one of the challenges that we have, and you see it kind of echoed in the United States as well, is because we have different regulatory bodies, like FinTrack and OSFI and the CSA. They're all looking at this kind of through different lenses. And I think the challenge that we're seeing, and we'll get into this a little later around taxation, but I think one of the challenges is that crypto assets can be quite malleable and they can be used in very different contexts. And so I think the other challenge here is, even to George's point, do you have to comply with everything or do you fit within certain buckets? And we're still trying to, I think we'd be remiss to not try and continue to try and harmonize both our classification as well as regulations across these different regulatory bodies. Because I think the issue we're seeing is there are starting to become some holes or arbitrage even opportunities because of gaps between different activities, whether they fall under MSB or whether they fall under securities or not. So one of the questions that I think I have before we move on is, it's related to a lot of the other topics, I think, but do you think that right now, I think generally the CSA and FinTrack have probably led the regulatory discussion around custody of crypto assets and then AML activity. What more could or should OSFI or even provincial trust regulators be doing to regulate crypto asset businesses? Do you think they serve a role there, or do you think that the way things are going today with FinTrack and the CSA being the primary engagement groups is the right path? I'll open that up to whoever wants to take it.
Eric, I can offer a comment on that. But I think where George and I see eye to eye on this is maybe we should be flipping the question you were asked earlier around, and should we be asking really why are we using foreign custodians, or should we be asking why aren't there more Canadian custodians? And I think this is where the role of OSFI and trust regulators may be very pertinent, which is, why is it that Canadian banks, Canadian trust companies have not gotten into this business? Why are they not entering the crypto asset custody business? Are they unwilling to? Are they unable to? I don't pretend to have all of the answers, but I would suggest that for leaders of those regulators and for policymakers, those are very important questions, because is the current regulatory environment basically forcing or otherwise inhibiting fintech innovation in Canada because of regulatory constraints among in the prudential regulation space? That is, what OSFI and provincial trust regulators have. Is that making it more difficult for existing players or new players to enter this industry? And is the use of foreign custodians really a symptom of a bigger problem with fintech innovation in Canada? And that's not to diminish the efforts of the players that are building these businesses, but I think the question is, what more could be done to remove obstacles that are preventing them from entering the space?
I'll add one more to the mix, and whatever you may think of it, I believe that the hardest question that no one's necessarily answered just yet in the United States or elsewhere is, what is a clearer test than the Howey test or Pacific Point test as far as what's a digital commodity and what's a digital security? Most of the trading and exchange platforms are still operating with their own digital asset selection frameworks, which are not easy to put in place first. But then to quote someone that's a lot smarter than myself, show me the incentives and I'll show you the outcome. The fact that we don't necessarily have a test as far as what could be a commodity and what could be security, more so than just a couple of indicators, resulted in effectively the regulators outsourcing the decision to the trading platform, future restricted dealer, and eventually a full investment dealer down the road. Now, as a regulator, my mandate is what? Investor protection, fair and capital markets, capital formation, all of that. As a trading platform, my mandate is what? Increase trading volumes, generate revenue, return value to shareholders, right? So outsourcing the decision of what's a digital security and what's a digital commodity to the trading platform itself seems like the wrong incentive to set, in my view.
I think that's a very fair point. And I would add too that I think the other shift is, towards not only securities or commodities and being classified like that, but also even as currency, because we do see these being used. And this is actually a great segue into the next topic, being fiat pegged crypto assets or stable coins. And I think they've been colloquially named as crypto assets that have their value pegged to a particular government issued currency. These could take the form of government issued central bank digital currencies, or CDBCs, privately issued such as Circle's USDC, Paxos, Pax, Gemini's GUSD, or Tether's USDT, or other algorithmic ones such as Maker's DAI or Cello's CUSD. At a market cap of about $107 billion, stablecoins are roughly under 8% of the cryptocurrency market, but the global demand and usage of stablecoins is growing at an extremely rapid pace. To put this in perspective, the amount of Circle's USDC issued has grown more than 2,600% since the start of 2021. And the amount of USDC in circulation has gone from 400 million to over 26 billion in just 2 years. Each type of stablecoin presents new opportunities as well as challenges and risks, especially I think as central bank digital currencies start to get deployed. But I think maybe I'll turn this to Brian. What are some of the leading use cases that you've seen in asset classes for stable?
Sorry, what'd you say?
Sorry, Kalea dropped and it looks like we switched over. The question I had for you, Brian, was what are some of the leading use cases in asset classes for stablecoins that you're kind of seeing today?
Yeah, I think it's helpful for people to understand why people are using stable coins. It removes the friction when you want to move between, different exchanges. So someone may hold an asset on one platform and then want to make a trade somewhere else. And, instead of wiring back to the bank account, if you can just send a tokenized dollar, which is, most of what these stable coins are, that's obviously much easier than using the traditional banking rails. And so what a lot of people want in the space, in relationship to why stablecoins are so big, is they want the flexibility of the blockchain, but then they want the stability and a US dollar to act as the quote currency in some activity that they want to perform. So it could be moving between two different exchanges. It could be people who want to move those assets out of an exchange and buy an NFT. NFTs, for anyone who's not familiar, is just digital art that has become very popular in the last 8 months. They may want to trade on a decentralized exchange, and having a better quote currency like the US dollar, or maybe we can see Canadian dollars play a part, would be great. Then that's where these stablecoins have really gained a lot of momentum. And it's going to continue. And it also is an opportunity. I think a lot of regulators are scared at exactly how they're going to take shape. And there's going to be lots of different flavors of stablecoins, as you were mentioning, whether it's backed by actual dollars or whether it's some type of algorithm. There's going to be a lot of different flavors of it, but as the space continues to grow, so will the demand. So looking forward to how Canada is going to play a part in this world. I'd like to see a Canadian dollar stablecoin enter into the ecosystem, whether it's in things like Maker or big international exchanges, ways to move between the local platforms and the big international platforms, I think would be great for everyone. So I think it's definitely an area that we should be paying attention to.
Yeah, I agree. I mean, I think as somebody operating on the payment side of things, I want to actually steer this question towards Pam, and then maybe I'll add my own opinion on top. I think clearly Brian articulated some of the value props of stablecoins and digital payments on blockchain networks, especially now that we're starting to see faster, lower cost blockchain networks. Do you think the growth of stablecoins is a symptom of issues or drawbacks with traditional banking and payments infrastructure?
Yeah,
or do you think,
I think
it's largely driven by, I guess to add a little bit of color there, right now people are earning yield that would be higher than a traditional bank savings rate by providing liquidity to some of these peer-to-peer networks. Do you think it's a combination of those, or basically a problem with some of our existing financial infrastructure here?
I think it's all three things really. So I think it solves for certain issues that moving around the Canadian dollar globally or moving the US dollar even globally solves. It's faster, it's cheaper, and you don't have the volatility of cryptocurrencies. So people started using cryptocurrencies for international remittance to solve some of those issues, but then you're exposed to the fluctuation in prices. So stablecoins certainly solve that. I think we see it on the exchange side a lot as a bit of a regulatory gamer. And what I mean by that is people will onboard Canadian dollars onto a Canadian-based exchange that has, by its own warrant, limited the amount of coins that it offers, or because it thinks that the Canadian regulators might want it to limit those coins. So whether it's doing it because it's decides that's the right thing to do, or it decides that the regulators might think that's the right thing to do, we offer a much more limited subset of coins for the most part in Canada than some of the international exchanges do. So what we see a lot is Canadians signing up for a platform like BitBo, buying a cryptocurrency that we offer, including a stable coin, and then transferring that out to finance so that they can get access to the coins that they want, even though they might not have access to those in Canada. And then I think the third thing, Eric, is you're absolutely right. So rightfully or wrongfully, if you're holding your money in these assets, you can earn a much higher yield than you can by putting your banks in traditional bank deposits. Again, coming from traditional finance, I worry about what that means. In traditional finance, you're always taught that if there's a yield to be had, it's because it's a higher risk product. And I think that's certainly true for some of these stable coins, particularly as we're seeing more proof of reserves come out that aren't 100% backed by the currency that they're supposed to be, but other things like commercial paper, et cetera, where you might not really know the risk there. If there is incremental yield, it probably suggests there's some element of incremental risk, and that's why the incremental yield was warranted.
Yeah, I think you're absolutely right. I mean, the other thing that I've kind of said internally, if nothing comes from crypto, I hope that we at least have improved over Swift, because the Swift network is so manual and so error prone to human error that at least the traceability and even the user experience that stablecoins offer, where you can verify that the recipient has in fact received those funds, that in itself is a huge time savings, cost savings, as well as the ability to, I think, help track down AML or CTF concerns. So
one more viewpoint to the mix. For us, it's all about fees. If we're to compare some of the crypto products with some of the back offices for sending wires like RBC Express or CMC, the CMO, you could argue that the experience is just as broken on both ends. Just lightly joking here. But I've yet to pay an incoming on-chain transfer fee on the blockchain. I don't know where these blockchain protocols might evolve next, but you know, like this, some of the fee schemes and structures in the traditional wire system just don't add up. Make me pay twice as much when I send it, but don't charge me when I receive it. If I understand that there are costs involved.
yeah, but I think you know, even to that previous comment, I think this is, you know, exposing, I think what we've seen in Canada, even with some of the lack of banks jumping in, or even some of the friction with AML and some of the challenges that even some of the banks that have been crypto forward in supporting crypto asset businesses, I know firsthand the challenges that they've run into is AML and a lot of the processes involved that are quite manual and maybe outdated as a result of using Swift, or as a result of using Interac, because a lot of those AML verifications are very manual. And I think this is an opportunity that stablecoins could enable. You know, I know Payments Canada has been working on real-time payment rail, recently selected Interac to work with one of MasterCard's subsidiaries that did the UK real-time payment rail. But I think, in my opinion, this process has taken so long that we now have open source, what I would argue is more secure, because the cryptography is baked in at the core, networks that now anybody can interact with. And so I guess this is a good segue into the next question that I want to steer towards Evan and Nate, is what do you think, I guess, what are the competitive or other risks to Canada and its economy if regulation impairs the adoption of stablecoins? Evan, do you want to take it first?
Sure. So a couple of thoughts on this, and I don't think I'm being too controversial in observing that, you know, the current Canadian payments infrastructure is really controlled by a bank oligopoly, and for either that or other reasons, there's a lot of innovation in payments broadly. Now I'm speaking beyond stablecoins. It's happening in other countries that's not happening here. And so if anything, the adoption of stablecoins and the growth of stablecoins as a payments innovation illustrates and underlines the need for there to be a more open and more competitive payment system in Canada generally, because obviously the market is speaking to a certain extent with this adoption of stablecoins as a means of payment. But in terms of focusing, that's more of a general comment on the need for innovation in payments generally. But with respect to stablecoins in particular, as I say, this is becoming a more important payment mechanism, not just in crypto, but in other industries as well. Sort of building on some of the comments that Brian was making. We're seeing people use stable coins for angel and venture capital investment. They're not even using the wires anymore. When they do a closing, they send a bunch of USDC or Tether or some other stable coin in order to close the deal. We see international companies paying their contractors and their employees in stable coins. It's being, and this is not specific to the crypto asset industry. This is being adopted by other technology industries. So if Canadian companies, Canadian workers are cut off from stablecoins, as if it's difficult to obtain them, if it's difficult to redeem them, putting them at a disadvantage in other ways in terms of either participating in investment, acquiring investment, doing business in a sort of globalized online world. And I think that needs to be taken into account, that if we do cut or sort of impair the adoption, or we're cutting off Canadian business and not just crypto businesses from an increasingly important payments rail that is used for doing business and investment in Canada and abroad. So I think that's a very important consideration that should not be lost sight of by policy makers and regulators.
If I can just hijack for 1 second and add to what Evan's saying, I think just to frame this entire discussion, everything that we're talking about here is what crypto did, what changed really about this technology is it created this very agnostic, doesn't care what jurisdiction you're in, ability for anyone to participate financially in buying art, whatever it is that people want to do. It didn't care where you lived. And of course, this is a huge challenge to regulators to figure out how, as things leave their jurisdiction, do they still meet their mandates. And the opportunity here, and also the risk, is that in Canada, if we're very focused on checking off a number of boxes, we're going to leave Canadians out of what's shaping up globally. And whether it's investors who want to participate, and it's also businesses that want to offer products. The platforms in Canada to date, as Pam was saying, have not been able to list or are afraid to list a competitive number of assets to all the foreign platforms. And I don't know if it's because lack of clarity from the regulators. I don't know if it's that they just don't have the capital formation and the ability to list those assets yet, but it's clear that Canadians want access to these things. And so if we're very focused on what's happening in Canada and making sure that we just check off a number of boxes, I'm worried that the rest of the world is just going to move on and build their own thing. I'm currently in New York. I've been here for a few weeks. I've been with a number of the leading players, whether they're exchanges or custodians here, and they're just years ahead in terms of what they're thinking about, new products that they can offer to customers. There is a little bit of a move first and then ask for forgiveness later from regulators approach. And maybe we need more of that in Canada. I know that's kind of a tricky thing to say, but I'm just being honest in terms of, investing in new businesses. We want to be competitive. We don't want to see opportunities form somewhere else and then say 2 years later, can we just build a watered down version of that here? We need to be, right at that forefront and creating those opportunities, those jobs, the ability to invest locally and having those businesses succeed on the same scale. Same with, just to go back to the custody point for a moment, custodians here may not be able to custody a certain set of assets in the space because they're not sure if they would be considered a security. And in this space, you have some things that are obviously commodities, some things that may be obviously securities, but then there's a lot of stuff that falls in this gray area that may be a security, it may not be a security, it may start as a security and shift to a commodity. Investors don't care at the end of the day. I mean, that's a bold statement, but the is if they want to access that activity, whether it's lending, borrowing, playing in DeFi, buying an asset and speculating, they're going to find a way to do it. And as Pam was saying, they can just use the Canadian platforms as rails and go off somewhere else. So the custodians, it's unfortunate because they want to be able to list more assets, because then they can turn around to the exchanges and say, you don't need to go to a foreign custodian, we can do that for you as well. And right now they can't, because they don't want to be offside. And so I think that there's a real opportunity here to clarify the regulation, to make sure that we're all on the same page and figure out how to move forward as a space, and whether it's exemptions, maybe it's more sandboxing and saying that there's going to be a few years where maybe some things fall into that gray area, and regulators are comfortable with that. We need to see how things shape up. It's an opportunity, it's a risk, but I think it's one that is an important conversation to be had.
Yeah, I think that's tremendously well said, Brian. I think this is a good segue into the next section. There's only so much time we can cover, so to try and keep things on track, I think there are other things we'd like to dive into at stablecoins, but I think you're bringing up a great point. And the question that I would have, maybe directed initially at Dina, are there jurisdictions that we think we can copy? Because I think the challenge that we've seen so far, and I have my own opinion on this, obviously, because of the business direction that we've taken. But I think one of the challenges is we're still being a little bit careful about how we classify certain assets and where they fit into our existing regulatory framework. Whereas other jurisdictions have started to develop bespoke, and while not perfect, it does provide some of that regulatory clarity. Are there jurisdictions that you think are doing this well? And if so, maybe why?
Yeah, so I had discussed Bermuda when we began this presentation. I think that, one of the things they did right from the beginning was develop a regulatory framework, because what that does for the business is it provides them clarity and a safety net. It gives them comfort in going to a particular place to do business, to develop, because they understand the context within which they are building. And that's important for people that are developing projects in this space. I think, one of the other things that I've been really blown away by in Bermuda in particular, again, has been how open the lines of communication are. I've sat, there was a very distinct, I remember several years ago, I sat with a regulator in one of the jurisdictions I was working with, and there was a consultation paper that had gone out to industry. So they were looking at developing, rules and regulations for digital assets in this particular space, in this area rather. And the regulator that I had spoken to didn't even know that you could trace through Bitcoin transactions. And I was completely blown away that we had, there's an instance out there where there's policymakers that are creating rules without fully understanding the technology or how it works. And, implementing these kinds of decisions have huge downward effects. So I've been to countless events where, and I know this isn't achievable for every jurisdiction, it's really dependent on size and complexity, but I've been to multiple events in Bermuda where you have the premier, David Bird, is walking around and he's talking to people and he's taking meetings and he's listening to, what the challenges are, what people need, what the regulator wants. There's a very open line of communication between people who are building in Bermuda and the Bermuda Monetary Authority, the regulator there. So I think they've got a few advantages. One is being very early in terms of adoption. Two is being quite clear with the regulatory framework. Obviously, that doesn't happen quickly. Just because you have a regulatory framework doesn't mean you're giving out hundreds and hundreds of virtual asset service provider licenses. You still take things slow, but you give people a framework within which they can safely develop these things. So, I would say if I had to pick one jurisdiction, I've learned a lot from them, and I think that we have a lot to learn. And put it out there to any of the policymakers that are on this call. We have governments out there who are willing to work with our government, who want to work with our policymakers. And not all of them have figured this stuff out. Some of them just want to sit with other nation states to figure out, what can be learned from one another, what can be built in collaboration. So if there's anyone on the call that is seriously considering opening up lines of communications with other jurisdictions, I can promise you that there are other jurisdictions that want to talk to us.
Yeah, and to
Eric, not to hijack the hijacking, but one of the reasons that, for example, I find it disappointing that an initiative like Vidali might be better served in Bermuda versus Canada, the world is moving to a streaming payments model. The speed at which your monetary supply is moving through the economy is a huge driver into the speed of the economy as a whole. And right, like what happens if I can get my payroll once an hour or pay my mortgage once an hour? This is where the world is going towards. The sooner we realize this and we can start adapting over here in the payment space, the better it is for everyone.
yeah, I mean, to add on to that, there is that is one of the wonderful side effects of this technology, is that previously GDP growth has been as a result and been changed as a result of technology innovation as well as monetary supply, and the amount of monetary supply injected into the country. Now, what this technology could enable is actually has only been in theory up to date, in absence of verifiable, real-time, low-cost payment rails, is that velocity of money could actually be, so exactly what you're saying, the turnover of how frequently it moves through an economy could actually be a better way of stimulating an economy without debasing or reducing purchasing power of an individual, and so, or a business. And so I think that's something that we're very interested in trying to prove out in Bermuda, and why, I echo Dina's perspective, why we were very purposeful on why we selected to move a bunch of our digital asset business operations over to Bermuda, because of the regulatory framework they have in place and the work they're doing with members of the CSA already, as well as other jurisdictions. I think the other ones that we've noticed that have done a good job, maybe in my opinion, not quite as good as Bermuda, but definitely up there, have been some of the work done in Switzerland. I know they've had some challenges by being probably the first mover or second behind Bermuda. The other one being Singapore, I think has done a very good job in a lot of their regulatory framework. And I know that at least FinTrack has a lot of collaboration with MAS over there. I would encourage that collaboration, but I do think that there are maybe ways that we can start to create a sandboxing environment or a regulatory framework that would enable businesses to innovate here, and potentially even collaborating or passporting some of those businesses that are meeting compliance in other jurisdictions back, or copying a lot of the same framework. I think what we're seeing is it's what Brian said. I mean, the challenge that we have today is that now anybody with an internet connection to VPN can access these decentralized crypto networks and exchanges and perform peer-to-peer trades. And it's happening at an incredibly fast pace. And I like to put it in parallel to what happened with peer-to-peer file sharing. We had Napster that basically took the brunt of enforcement, but at the end of the day, it became a game of whack-a-mole, where now anybody with an internet connected device could spin up something similar to Napster. And I think we are entering that age, if not, we've already entered that age within crypto. And it makes it, very difficult, if not maybe impossible, for regulators to enforce traditional regulatory measures when all you need is an internet connection to launch peer-to-peer exchanges or decentralized money markets or automated market makers and more, which I think begs the question, like, how do we actually protect investors in this environment, and can we? And I'd maybe like to turn that over to Nate to see if he's got any perspective on that.
As you've mentioned, it's difficult because as you said, anyone with an internet connection can essentially jump into this space and start operating. So I think there's a difficulty for regulators to deal with that. I think there's also some of that difficulty also comes from the fact that I think regulators right now are kind of stuck applying a framework that was not built with cryptocurrency and crypto assets in mind. It's sort of an aged framework that they're trying to amend and use in this sort of new space. And I think that creates a lot of difficulty. And I think there is a need for some more concrete rules and regulations that pertain directly to crypto assets in order to deal with that. To me, that was always a big concern that I had. Of course, I only speak on behalf of myself, but I think to properly protect investors in this space, we need some more development of actual rules and regulations. Guidance is helpful, of course. Policies are helpful, but actual rules and regulations that we can adapt to this space in particular, that regulators can then more easily use to try and enforce against bad actors in the space.
If I can just add in a tiny bit of color here, my answer to this is all about disclosure. I think if you frame what's happening in the world now, to say, Eric, your comments in a different way, regulators and financial markets have existed pretty similar in a way to an editor of a newspaper. You're going to distribute content to a very specific group of individuals in a very specific jurisdiction. You're going to control the font, the articles, the subjects, and we're moving into the world of Twitter, where that editor of the newspaper is going to have people in their jurisdiction interacting with billions of tweets that come from anywhere, from anyone in the world. And you're not going to be able to look at every single transaction. You're not going to be able to look at every single tweet. And so the question is, how do you still protect them? How do you apply the initial principles and spirit of what you're trying to achieve in this new environment? What role as the editor of a newspaper do you want to play in the Twitter world? And to me, the only answer that I can come up with, and I've thought about this at length as someone who uses the technology, who yield farms and plays in DeFi and plays around with staking, all the cutting edge stuff, is around disclosure. That you can try and offer a lot of these products inside of well-controlled exchanges like a Wealthsimple or other great players in Canada. And if you give people the access and we let them list numbers of assets and different ways to lend and just participate in the space, the users who aren't comfortable going off into the Wild West will use those platforms. There's still going to be a subset of users who want to go off and play in the decentralized world. And then it really just becomes about disclosure. When you remove those assets from the platform and you take control and possession of them, you have to make sure that those users are educated, that they understand that they're at higher risk maybe of losing those assets or theft or scams. Maybe the assets that they're going to interact with down the line may not be what they appear to be. It could be a fork of something, a clone appearing to be something else. The point is, there's an opportunity when people leave these closed environments to just educate those investors and make sure they understand the risks that they're taking on when they take possession of that, that share certificate. That's kind of the only way that I can see achieving that goal, plugging into the DeFi world.
Not everyone that's doing something different is a bad actor. We wouldn't have innovation if that were the case.
Yeah, and
Go ahead, Dina.
maybe just to add on top of this, I think this is the beauty of sandboxing, right? You have this brand new technology, and the idea is there's this ever growing and consistent education campaign that happens all the time. It happens for people that are deep in this space. It's happening for people that are on the policy making side. Because this is brand new, we've never had anything like this technology before. And even if we look at, some of the AML stuff that we talked about, where we're just taking an existing framework that was developed for an opaque technology that is cash, and we're sticking it onto this new thing, we're finding all the ways in which this is building limitations that this technology is trying to, save us from. So I think we very much need to, we have to have an honest conversation about the fact that there's a lot of learning that everyone needs to undergo, and we need to have the appropriate guardrails in place to allow people to experiment with this technology in a way that is safe. And I think, Brian, you're right. Disclosure is, I see that as a very happy medium. Let people know what the risks are, but then create a forum within which people can actually start experimenting with this stuff.
I personally think, this is why we separated DeFi, because it's quite deep. But I think what we're seeing with the emergence of decentralized exchanges, where you may not even know who created the exchange, but now has billions of dollars in liquidity. And, there is nobody to hold accountable. To put it bluntly, if bettors want to bet, they're going to do it. They have the tools to do it, and there's no way to stop them. And I think my concern is when you look at consumer protection, because failures and theft and fraud affects everybody in this industry adversely. So how do you protect consumers? And I'm with you. I think the only way is to create a sandboxed environment where people can play, as well as appropriate disclosures to do it. Now, the last question I kind of have here, which I think, and I wanted to acknowledge all of the regulators that are on the call. I think all of us acknowledge that this is not an easy, you have a very, very challenging job. And I think we all recognize that, to find that balance. The thing that I've been thinking about a lot, and even had discussion with the head of the Bermuda Monetary Authority, Craig Swan, just recently last week, is, does the role of a regulator change? And right now we have kind of absence of legislation and regulations. We have ones that we're leaning on that are historically applied to securities, or I would say now with AML legislation that's been updated, FinTrack has been doing a great job with trying to keep up to date with everything that's been happening, especially at the pace that it's moving. But I think most of the stuff that we've seen so far has been regulatory guidance regarding crypto trading platforms and lending and custody and stablecoins. Do you think this is adversely affecting investor protection as opposed to actually helping? And then, should Parliament or provincial legislators be amending existing laws or creating a new laws to better protect investors, similar to what we've kind of seen in the Bermuda Monetary Authority with their Digital Asset Business Act? I'll maybe pose that over. I'm going to throw that Brian's way first, as somebody who kind of straddles the investor side, entrepreneur side, and has been kind of all over.
I mean, I don't actually have a strong view here. I think that we're starting the conversations. I think that there's the beginnings of guidance coming out on how platforms can start getting more competitive with foreign exchanges. It's still going to take a while, but at least the conversation is starting. I think your point on more open dialogue and conversation, and everyone coming to a table and thinking about what is maybe the way it has to work is, the investor wants to do the following 5 activities. How can we facilitate that in a way that achieves all of our objectives? Because the reality is that investor is going to do those 5 things, whether we let them do it on a Canadian platform or they're just going to find some way to do it somewhere else. They're better served or better protected if we can do it locally. Dino was talking about law enforcement being able to have an easier line of communication with custodians if they're based here. That's probably very true. So the question is, how do we then create those environments to say, you don't have to go off into the Wild West, or you don't have to go off to Binance or foreign platforms to do those 5 things. We're gonna facilitate that here in a safe way. That to me is probably the most pressing thing. It's probably the thing that would allow businesses to move forward. It would allow investors to stay here and feel that they can achieve their goals here. That's what I would like to see happen more of. And so, roundtables like this are exactly what we need, and more dialogue between, I think there's this kind of regulators over here that doesn't really talk that much to industry, who doesn't talk to investors. I mean, I think that there's a communication channel between investors and industry, because you get to see, as Pam was saying, you see what they buy and then where they go and what they're kind of trading and what they're looking to access. But there seems to be a disconnect between the regulators and industry, and I think we all need to come together and say, these things are all going to happen, so how do we facilitate it here and keep that activity here?
Yeah, and I wanted to throw it out, if anybody wants to take that as well, especially if there's any, the groups who've actually gone through some of the sandboxing to date. I know there has been some friction. I don't know if this is something you want to speak to with Wealthsimple having, kind of gotten some form of stamp of approval.
Well, the reality is that in my first day was the day after Wealthsimple got its latest order. So I actually wasn't around for a lot of the work that went into that on both sides. But I just want to pick up on the question that you asked about, Eric, about sort of the role of Parliament and legislators here. Right now, I mean, the legal regimes that primarily apply to crypto businesses are securities laws, are anti-money laundering laws. But the economic activity that's happening in the sector is moving beyond trading of crypto assets. We've already touched on how lending and other yield opportunities are an area of enormous growth. We've already touched on how stablecoins are being used for payment. So we're now moving beyond the legal regimes and tools that exist. And absolutely, investor protection has to be at the forefront. But from a policy perspective, it's not the only imperative here. In my view, international competitiveness, economic growth have to be taken into account at a policy level. And just to illustrate, the businesses in this space have created an enormous amount of value in a short period of time. Coinbase is a $50 billion market cap company. FTX just was valued at $20 billion. These companies didn't exist a decade ago. FTX didn't exist 5 years ago. And companies like that, it's not just trading platforms. They're creating jobs. They're attracting investment. They're paying taxes in the at least in certain jurisdictions where they operate. And they're also very sensitive to the regulatory environment that they operate within, and they can move their operations very, very easily. And then I also want to note, so that's I think there are other policy imperatives beyond, in addition to investor protection, that have to be balanced at a policy level, at a legislative level. We already acknowledged how the work that regulators are doing. And you noted, Eric, that it's not an easy task, and I absolutely agree with that. You have what clarity that has been created in the industry has been created by regulators, filling gaps in existing legislation, in the absence of legislation, through guidance, notices, terms and conditions. But in an ideal world, many of the things that are being done would happen with the consultation, the transparency, the political accountability that goes with legislative amendments or even a new legislation. And there are also limits to the tools that regulators have available to them. They are doing what they can with the tools they have, but one thing they cannot do is change the statutes that give them their authority. And I think what we have seen or are starting, and we'll see more of, is regulators bumping up against the edges of their jurisdiction, and where there's a real need both for investor protection and for promoting economic growth for legislators, those who make laws and governments, to clarify matters that are not clear and provide regulators with new legislative tools, because the activity it's no longer strictly analogous to securities trading. Anti-money laundering is not the only consideration with movement of money. We do have to consider how this affects Canada's overall competitiveness and growth and job creation. And those are matters that really need attention from the policymakers and politicians in a position to make new legislation or enact new regulations, because that's now outside of what our regulators can do. So I would like, that's being more of a general comment, but I do think there's an imperative for policymakers and politicians to know that they have to play a role here as well, and they cannot simply leave this to regulators to figure out without giving them the support that they and the industry participants need.
Yeah,
May I go for 30 seconds on this as well? So the good news is some of this is already happening. Like, I'm personally extremely excited, for example, to see what the new OIC Innovation Office will do. And this is, we're looking ourselves as a potential prime candidate for an initiative like this as well. To take it to investor protection and competitiveness, and how do we actually accelerate this development at both policy and regulatory level? We've been in a situation where the consumers were going offshore to get the services, like Brian said. We're in this situation now where we're onshoring the business activity again, and this is good. The fact that Wealthsimple is here, the fact that we're all here and still in business and on this panel, this is extremely good news. Now, we are in a bit of an intermediate state where, because of some of the attention that's going to the DeFi ecosystem, now you might have onshore regulated businesses that are served by offshore technology service providers, which introduces its own kinds of worms and moral hazard. So I would say let's accelerate a little bit the policy development process to go past this intermediate step and bring over the technology providers onshore as well.
Yeah, I would agree. Nate, I wanted to kind of turn it to you, maybe to kind of round out this section before we just jump quickly to taxation, and then get your perspective. As somebody who's been on the other side of the table, do you feel like we need to potentially make legislative amendments? Would you echo, I guess, Evan's opinion?
I do. So I agree with quite a bit of what Evan had said just a few minutes earlier. I think the framework the regulators have to deal with crypto assets it really was never built with crypto assets in mind. And there are concerns that I think regulators are going to need more tools to deal with this. I think the space is moving beyond exactly what Evan said. The space is moving beyond what our provincial securities acts were originally intended to address. A lot of this is new. A lot of this is changing very quickly. And I think there is a need for there to be some additional tools to regulators to address the space and the changes in the space. And I think they're going to need that sooner rather than later, especially with how quickly things have been changing recently. So my view is that I do think there is going to be a need for some legislative changes here to assist regulators. And I think there's going to be a need for that sooner rather than later.
I appreciate that. I think also a great segue to the next one around taxation. I think this is one thing that's even been quite unclear for a while. The CRA had put out guidance around how crypto assets should be taxed, and obviously you need to be claiming these on your holdings on your tax year end. But what do you think are the most pressing issues involving taxation in crypto assets that may require further guidance or legislative reform? Evan, do you want to maybe take that one?
Yeah, I offer some. It's going to be maybe a little inside baseball for as it applies to trading platforms. But I think it also illustrates a theme I want to emphasize here, which is about some consistency of regulation. Recently the CRA, obviously the CRA is very interested in what income and gains Canadian taxpayers are reporting and paying taxes on when it comes to crypto assets, and they recently took steps to get a court order to and exercise their powers under the Income Tax Act to get information from one of the other Canadian trading platforms. And I think what that illustrates is a couple of things. One, it is a very ad hoc approach. That kind of obviously there's a need for tax CRA and other tax authorities to have that kind of information to carry out their mandates. But the way that it was gone about, it's always struck me as it's a tremendous operational burden, no doubt, on those who have to comply with that kind of approach. It has public relation consequences because it gives the appearance that the platform has done something wrong. It creates an unnecessary tension between the platform and their customers, because it looks like they're sort of handing over their clients' data. And it's very ad hoc. It's being applied to one platform and not others. I would like to see, from the tax perspective, if that's what's required, well, then there should be some consultation to come up with an approach that takes into account those considerations that I've identified and is applied consistently, not just across Canada, but also to foreign platforms that are serving Canadians. Because if that's going to be something that's applied to Canadian platforms, then those outside Canada should have to play by the same rules. And I think that's a comment that applies more generally, that protecting investors requires consistency of regulation. It can't fall solely on Canadian actors. And we do know in this space that many of the largest platforms are outside of Canada and are not necessarily complying with our laws. And are prepared to comply with our laws. And I think it's important for investor protection and other reasons that laws be applied to them as well. And also those that are operating from outside Canada, but serving Canadians, and they should approach compliance with Canadian law with urgency and be accountable for that. And I think that's a comment that applies not just to compliance with tax, but really all of the laws that apply to crypto businesses in Canada.
If I can just chime in for a moment, one thing that I think is desperately needed is more guidance on how certain types of activities are looked at by CRA. So a lot of the guidance is just around very basic trading, but you get into things like, how do you define in this space what a like kind trade might be? When you dispose or swap Bitcoin for something called wrapped Bitcoin, which is a flavor of Bitcoin that can just move around in another ecosystem, did you dispose of the asset or did you just convert it into another flavor of it? I mean, I don't have an answer to this. I talk to a lot of people in the industry and hear, tons of different answers of how they're treating it on their tax returns. But I think that it's been around long enough that we need clarification on things like that. We need to understand how staking might be looked at. What if you are staking an asset, but you could easily say or counter that by saying, when you have access to the asset or when it gets dropped into your account, but it's possible that your asset is locked up for some period of time where you can't access it yet. At what point would that be considered a taxable event? So there's all sorts of really nuanced questions. I would love to see CRA have some consultation with industry. Perhaps that's going on and I'm just not aware of it. I would love to be part of those conversations. Because I'd like to know, personally, as someone who's been part of the industry, as I'm watching the activities get more and more complex, there's just more and more questions, and it becomes very difficult to figure out what the best way is to comply.
And I might add to that, currently the guidance in the way that it's written specifies that there are potential tax consequences on dispositions. And one of the activities that is considered a disposition is using cryptocurrencies to buy and sell goods. And that obviously has a huge implication for retail markets and the ability for merchants to accept crypto. So I think we need to really spend some time thinking about, the future of this ecosystem and how the tax obligations that we're building in now might impact that future.
Yeah, so as far as the GST, HST treatment of crypto assets, I know there's some draft legislation somewhere out there that basically would categorize crypto assets under Section 7 of the Excise Tax Act as a non-taxable supply if you're doing it for investment purposes, the same as any other financial product, right? I get taxed on my income. I don't get taxed again if I go to Tangerine to buy a mutual fund. But I haven't, it's not entirely clear where that is in the process just yet. So.
Yeah, and I think, this is why I think a lot of these topics are all interrelated, because the nature of taxation, whether we're talking about mining or airdrops, where people are airdropped you tokens, especially tokens you don't even want, does that create a taxable event? Staking, how does this impact donations? Because right now, currently from a tax perspective, in Canada, cryptocurrency is treated more like property, and transactions are treated more like barter transactions when you're paying for good or service. Like Dina mentioned, disposition. When you're trading it, it's treated more like a security, right, with a capital gain or capital loss. But I think because of this technology, we've really changed the nature of what ownership and custody actually means. And so, in theory today, right now, the way things are written, sending crypto assets to another address that is not controlled by your own private key that you own could trigger a taxable event. To what Brian was mentioning, or whether even you move from your own private wallet to an exchange, even if you haven't even made a trade yet or converted that asset for a gain or a loss. And
sorry, Derek.
So I was just going to say, I think this causes major issues and confusion because from a tax perspective, crypto assets aren't treated quite like the same as property, currency, or securities, but they can take all these different forms. And, I guess the question that I would kind of pose is, along the lines of crafting new legislation, do you think that we need to create a harmonized classification system for crypto assets that kind of spans these regulatory and legislative authorities?
The tidbit of insight that I got, which is, my apologies, why I interrupted a bit earlier. I guess one interesting tidbit of insight is one of the definitions that's being circulated as to what a crypto asset is, which sometimes goes along the lines of any cryptographic private key that can be used to control virtual currency that can be easily converted into other virtual currency or funds. We got that wrong. The private key is not the crypto asset. If someone shows up, to take the airdrop example, if someone shows up to my door and leaves a package, is it my package? Do I have the package? If someone airdrops an asset and I have a private key that happens to control that particular asset, do I have that asset? Should it have triggered a tax event? In my view, no. I would argue that the crypto asset itself is in the relationship between the private key and the network protocol where the crypto asset is being held that allows you to spend it, not the private key itself.
Yeah, I think that's really important. And it obviously, this is a mouthful. That's a very nuanced take, but that's the challenge that this technology enables, because, even in the case of donations, we have a case where Vitalik Buterin, creator of Ethereum, was airdropped a bunch of tokens that he didn't really want. And so as a result, he donated these to a group in India so that they could liquidate these. And we're talking billions, I believe, or over $1 billion worth of assets, so that they could use it for COVID relief in India. And right now it's totally unclear as to where taxes to be paid, who pays them, would a nonprofit pay them, would you be able to offset capital gains on them if you were taxed on that disposition? Right now, the answer is no. And so I think even in the case of donations and paying taxes appropriately, the confusion is inhibiting not only the ability for people to donate who want to, but also inhibiting even how to account for taxation within the business models that are developing. So with that in mind, we're running up against time. We're a bit over if we include question period. What I do want to do is leave a few minutes if panelists have the time to let some of the legislators raise their hand and put forward a question. We have some great questions in the Q&A. I've taken note of those. They're not ones, some of them we can't even address ourselves, unfortunately, as they are directed towards regulators. So I think it's good for them to consider. And we'll make sure that those get into the attendees' hands. But if there are any regulators or legislators that have a question they would like to ask to the panelists, please raise your hand. Should be down at the bottom of your Zoom call. And if not, I'll turn it over to Kalea for kind of the next steps. Unless, did Kalea have to drop or is she on? Yeah, she is on. Perfect.
Yeah.
So I think while we're waiting for people to decide, I think one of the things that all of the panelists have mentioned, and the reason why they're here, I want to thank all of them for taking their time, because this was not paid. They're taking time because they care about where this is going and how this impacts Canadians. I think we're all on the same page in that we're open to engaging more with regulators and legislators on this. So more than whether it's through private consultation or through, which some of us are already having, or whether it's through the Canadian Blockchain Consortium, that invitation is open. So I'll hand it over to Kalea to wrap up.
Awesome. Thank you so much. Let's see. Sure. I just want to thank everyone today for attending. We're really excited to be able to host these roundtables. As Eric said, the next topic that we're looking at would be on DeFi. The date would be around the 3rd week of October if everyone goes for that. So we will circulate it once we know the exact dates and times, and we hope you guys will attend again. I want to make sure we give a great big thank you to the team who's worked tirelessly to put this together. Emma Todd is the chair of our FinTech committee and definitely the powerhouse behind getting all these roundtables and everything going. And big thank you again to Adam O'Brien, who is our co-chair. So these two have been leading our FinTech committee since day one. Dave Bradley, who's a member, he's also the VP for the Canadian Blockchain Consortium. So he's a co-founder who helped me put this organization together. A big thank you to Dina Mainville for being on our committee, as well as being an incredible part of this panel today, as well as Pamela Draper. Pamela is also with Bitfo and Patano, and they've been with us since I think our CBC started. So thank you. Wayne Logan also sits on our board of directors and a member of our team. Eric, I know you have done so much effort and so much work to put this together. So thank you again. I know you've done a lot of interfacing, especially with Denise, and helping get all those invitations out and then organizing so much of the structure. So there's definitely an incredible amount of work that goes on the back end of this. So thank you. And then George, for being a part of this, for being a member of our FinTech committee. Rodney, who I don't know if you're here today, but hey, Rodney, thank you as well. And then Matthew. So we have a really great team. These are the people behind our FinTech committee that help come up with the questions, the roundtables, the webinars that you guys see every single month. So it's a really powerhouse team. We're very, very grateful for them to be a part of our organization and for supporting the FinTech committee as a whole. I wanted to give a bit of a shout out. If you're not aware, we do have a free magazine that comes out every single month. There's a lot of really amazing content that comes from here. We do a lot of research in this space and try and put something together it's a quick read, but it'll keep you up to date on some really fascinating topics, and a great way to stay up to date on the webinars, the roundtables, and different things that we have. So if you're interested in checking it out, it comes out the first of every month. CanadaBlockchain.ca is the website you'll see it on. Of course, again, as a not-for-profit, we don't have any paid employees. This is a completely volunteer organization. We're really, really grateful to all the members that we have within our organization. If there's any of you today that really enjoyed our roundtable and would be interested in supporting our amazing community as we continue to grow and helping us cover the cost of operations by becoming a member, there's a lot of amazing perks to it, but we definitely appreciate and welcome any support that our community wants to give to us. If you're looking to learn more about the options and the way that we support you for becoming a member, please again, check us out at canada.blockchain.ca, send me an email. Other than that, thank you guys so much for being a part of this. I hope you guys really enjoyed it. And big thank you again to the team and Denise for all of the hard work to put this together. So thanks, guys.
Thank you for having us.
Thank you, everyone.
Thank you, everybody.
Thank you very much.
Thank you,
Yeah.
everyone.